Africa's third national budget of the year is set to be tabled this week amid growing debt, slow growth and limited tax options. While a VAT hike is off the table, experts are warning that taxpayers could still feel the pinch through bracket creep, few levies and reduced tax credits. Let's break down what to expect. And Sanlam economist Patrick Buthelezi joins us now. Patrick, good morning and thank you very much for your time. We appreciate it. So we've seen two budget attempts fail this year. What makes this budget different? And is there a real sense that this one will finally stick?
Good morning, Iman, and good morning to all the Newzroom Afrika viewers. Yeah, it's very interesting and unprecedented in South Africa. So I think what we have seen in the past two budgets is that politically there is no appetite for tax hike, at least not a VAT increase. So I think in this budget, what we can expect the focus to be more on expenditure cuts as opposed to raising taxes. And I think in cutting expenditure, I think the focus will be more on the funding areas that are identified in Operation Vulindlela, which, I mean, those areas will be more about growing economy over time. So, yeah, it's a very interesting one, and I think it is important for government of national unity to have a consensus about how they structure the budget to prevent what we have seen, I mean, in the past two failed attempts.
So, Patrick, while VAT hikes appear to have been taken off the table, you and there have been other economists as well that have warned of stealth taxes like bracket creep, which would remain. So, again, I think it's worth revisiting that in the lead up to tomorrow. But how much more can taxpayers realistically absorb under the current economic conditions?
Yeah, it is very difficult. I mean, the problem, because the biggest problem in South Africa is an economy. Because also, if you think about the context in which this budget will be presented, I mean, in March, when the finance minister presented the budget, the expectation was that the economy will grow at 1.9%. But I mean, 1.9% is very optimistic at this stage. So you would expect the finance minister to reduce GDP growth forecast. So what it means is the revenue that government will collect. So assuming the assumptions they made previously continue, so they will collect less revenue. So if you add scrapping of VAT, so which means this budget, there will be a big hole, I mean, starting off of the budget. So what it means is to plug this hole. So what government will do to try and plug this revenue hole. So you would expect a bracket creep to be there, obviously, and also you would expect excise duties to increase above inflation. But I mean, to try and balance the numbers, because also what we have seen from the past two budgets is that the National Treasury, the strategy is to balance, is to try and stabilize debt. And how do they do that? Stabilizing debt by running primary budget surplus. And I think they will continue to stick to that. So in the near term, we might see a deterioration in the budget deficit, but in the medium term, we can expect the National Treasury to stick to the strategy of running a large primary budget surplus, because the intention here is to balance is to stabilize government debt. Because what we have seen is the level of interest that South Africa is paying. I mean, the projections in the March budget was that we were going to pay close to 500 billion 2028, 2029, which is crazy. So I think they will stick to that, but in the near term, the pressure will continue. And also, what we have seen, I mean, demand for expenditure continues to build. For instance, the beginning of the year, we saw about over 200,000 people losing jobs, which means demand for government to support people continues. So balancing the two it's going to be a bit tough for the National Treasury.
There's also talk, Patrick, of reducing or eventually scrapping medical aid tax credits to support the rollout of the NHI. What impact could that have on middle-income households and the private healthcare sector?
Yeah, I think scrapping out medical aid taxes will squeeze, I mean, will continue to squeeze the household, especially middle income households. They are already squeezed, by the way, because they have to support more people because unemployment in South Africa is very high. So the burden is very high for middle income households. So about funding NHI, I think there is also another a big question, taking into account that politically there is no appetite to raise taxes, because if you scrap medical aid taxes, it will not be enough to fund NHI. So you need more resources, and the question remains as to where those resources will come from, and given the fact that politically there's no appetite to raise taxes. So what this means is, I think in the near term, we manage this, but I think it boils down to politics. It boils down to politics, government of national unity, reaching the consensus as to how they structure this budget, but to achieve number of things, because at the end of the day, all we need is for the economy to grow, because if the economy is not growing, you can't solve anything. I mean, the fiscal pressures will continue if the economy is not growing. So what is important is to ensure that there is a credible plan, and that plan is funded, but over time that plan yields a higher economic growth.
Growth is just it's that elusive unicorn in our economy, and has been for so long. And these latest quarterly labor force survey results don't imbue one with confidence. Well, let's talk about the fuel levy hikes also back on the cards, and how will that affect inflation and consumer spending, especially in this environment we're talking about now of sluggish growth?
Yeah, I think if they, I mean, if they hike fuel levy, because by planning not to hike fuel levy, they were going to lose over 4 billion. So if they hike a fuel levy, at least at this stage, oil prices are very low, and also inflation. Inflation at this stage in South Africa is very low. It's below 3%. So the impact on inflation will be minimal. That is, if they decide to raise a fuel levy, because inflation in South Africa at this stage is even below the lower target. So the inflationary impact will be minimal. So on inflation, the impact minimal, and also on the growth front, because inflation is very low, it will not make that significant negative impact. That is, if they decide to bring back fuel levy.
All right. I know SARS has been looked at. They need to collect more money. They need to not raise rates. But I want to go to this question in closing. With the expected 60 billion rand in budget cuts and little room for brand new revenue, what would you say is the biggest economic risk if this budget fails to strike the right balance?
Yeah, I think the fiscal credibility crisis, if this budget also fails, I think we are running the risk of a fiscal credibility crisis, because without a budget, you don't have government. Yeah, so it is. I mean, it is very important that this budget goes through, and then probably by October, I think they would have had enough time for the National Treasury to have a comprehensive review as to which programs are not adding more to society or economic growth that can be cancelled, because at the end of the day, we don't have enough resources, and also the tax base in South Africa is very low. So we have very low people paying taxes, and the burden they are carrying is significant. So expenditure needs to be aligned with that as well over time. So we must avoid the fiscal credibility crisis. So the budget must go through, and politically it is important that government of national unity work together and reach a consensus as to how they structure the budget that will serve the South African society, given also all these challenges globally.
All right. I think we've covered quite a bit of ground. Patrick, all remains to be seen at 2 p.m., I believe, is the hour tomorrow when the country finds out exactly which way Godongwana is going to slice this pie. And we'll be watching that together. Sanlam economist Patrick Buthelezi, thanks again for your time.